Hello monsters, let's take a quick look at one of the stocks on my watch list today. It's Hanesbrands, symbol HBI. Here's the daily chart. Now let's take a quick look at technicals first. See how this is stock back in February. It was trading right here around $29 a level. We saw some put activity going into the earnings, and those put buyers were right on the money. Earnings came out, stock got hammered big time in February, and then came on high volume, and then it slowly rallied back on low volume, filled that gap right here, and basically created a double topping formation right here, also at the same spot where we have this large volume over price resistance, these horizontal bars that I show in the chart. So after making the double top and making a failed breakout attempt right here, now it's starting to roll over again, and it's sitting right here at $28 and let's call it 10 cents level. So if I draw a little support line right here, you'll see here's the support line. Let's make it a little bit bigger so you can see more clearly. Here is your support right around 28.10, 28.15. So as it's trying to break down over here, there's really no support that comes into play until right here, I think around 27.10. So there's about $1 easy breakdown coming all the way up to 27.10, and if it's not able to hold there, I don't see this thing stopping probably all the way up to 24 to 25 level, which means it's going to be probably retesting these lows from February. Now going to the option market, here's the option market, Hanesbrands. Notice the 3,000 volume here. This afternoon they bought 3,000 of these contracts for 90. These are May 26 strike puts. They bought $300,000 worth of these contracts. They paid mostly 95 cents to $1.05. So this will cover the next earnings cycle because earnings are scheduled on April 21 right here. So they're basically looking for a move down below 26, and with the break-even point on these puts is about $25. So that's what they're betting, that with earnings coming up on April 21, they're placing bets early. They're looking for a breakdown, and they're looking for a stealth rally, a stealth sell-off all the way down to 24 to 25 level. I think it's possible. Let me explain why. On the fundamental side, here is Citigroup. Basically after the last earnings report came out, this is a report from February 5th. Total revenues for the quarter, for last quarter, were down 7.4%, and this was well below. The total revenues were $1.41 billion. It was well below the previously issued guidance of $1.52 billion. On a percentage terms, the analysts were looking for 2% decline in revenues, mostly due to very unusually warm weather last winter. The company posted much worse 7.4% decline in revenues. All major categories were down. The innerwear were down 2%. The activewear was down 12%. Significant. And a lot of analysts came out at that point and they tried to defend the stock. They said, we continue to like it. Here's Citigroup doing it right here. Here's reasons to continue to like HBI. Basically, it goes on in the detail why they still like it. However, here's one note from Credit Suisse, and it says, not so fast. Here's why. Not only every category, every product category was down. The inner sales were down 6%, the outerwear were down 1%, but most importantly, international sales were down 17%, which was much worse than 3% decline that the street was estimating. Why would international sales be down 17%? That much. That's including to Forex account. I mean, that was not impacted by weather. Then you have DTC sales that were also down by 9% when the estimate was 5%. And most importantly, if you thought it was all related to weather, here's another thing. Sales weakness was a function of both unfavorable weather, but also significant decline in retail traffic, which was down by a high single-digit percentage in November and December. Right here. So foot traffic was down. All channels of the sales were down, margins were down, EPS were down, and I mean these were pretty horrendous numbers. So going back to the chart, if you think that this particular sell-off right here was just a one-time outlier event and basically it was because of warm weather, I think there was a lot more to it when you have especially foot traffic also going down. So technically it came back on low volume, it filled the gap, it formed a double top, it tried to break out, it could not, and now starting to break down, and you have May 26 put buys right there. Here you go. They just bought 400 more contracts of this. So just when I started talking on this webinar, they are on this video. They were 3,000 volume here, and it looks like during these last 5 minutes or so they bought 400 more contracts. Now it's 3,400 contracts, and so they're looking for a breakdown, and they're looking for continued move lower all the way down to low 20s. So how would I play this? I think frankly the easiest, the simplest way to play this is by creating a spread or by buying straight puts. So basically buy the in the money May 29 puts. You can get these probably, there's a bid ask is 2 and 235. You can probably get them for 225 and sell against it 24 or 25 strike puts. So basically you will create this $4 wide spread, which will cost you about, let's say, $1.70 to $1.75. So May 29, 25 put spread for $1.65 to $1.75. I suggest in the money puts because you want to go with a higher delta on this, because you're simply looking for a move down and so you can exit. This seems a little bit too far out of money because, you know, this is about buying a straight May 26 puts would require, you know, this is about 8% out of money, so it basically really reduces your break-even point. The alternative, if you do not want to buy a put spread, just buy straight puts. You buy in the money straight May 29 puts for $2.25, and stock is already trading at 28.06, so it's already in the money. It's already $1 intrinsic value in these puts. Look for a sell-off and basically look for a move down all the way to 25 to 26 level. This would be my target, and at that point you can exit. That's it.